Let's begin. Welcome, everybody. Today's session, our eState Academy webinar, is on drafting simple gifts. And this time we're going to be concentrating on bequests and devises. So gifts of personal property and gifts of real property. So, the first thing that I always ask whenever a client tells me that they want to give away an asset, whether it's personal property or real property, specifically, I always ask, is there a really good reason to give this specific asset away separately? Because of course, the value of this asset is going to change over time, and it will almost for sure not be worth exactly what it's worth today and the date the will is made. And so we're sort of trying to be a fortune teller. And I would drill down and ask them, why not include this as part of the residue of the estate? And they say, well, because I want them to have that, that asset to use or whatever. Well, then there's always the option to take it as part of their equal share. But giving it as a specific asset means they get that regardless of its value at the date of death. And so that's always a bit of a tricky thing, especially when you take into consideration the myriad of issues that have to be considered. So here are some of them that we came up with. So when you make a specific gift and, proper identification and definitions, redemption, what happens if that asset's not around, ownership, cost of delivery, the implications of tax on it, etc. So we're going to run through the drafting idea of a number of these. Some I'll cover in bequests, some I'll cover in devises. So the first issue is typically, can we identify this specific asset, and can we give it a proper description that will be so clear that no one, the estate trustees, the beneficiaries receiving it, and the other beneficiaries could argue that it's not that item. And really that's the level of identification, because if the estate trustee doesn't know what it is, well, then we've got a problem. If the beneficiary who's receiving it isn't satisfied that that's the right item, we've got a problem. And if the other beneficiaries say, well, that's really not the item that the testator meant, then we've got an issue as well. So what I would always suggest we consider is using a definition for that asset that we're giving specifically. So, if it's my personal effects as a specific asset, if we're giving those away, let's define that. If it's shares in a company, let's make sure we define what's meant by the shares. If it's a question of, bank account, can we identify that bank account specifically? So, the other thing is to consider maybe some sort of dispute mechanism if there's some question. And this is one that we put in eState that, if there's a question as to whether something is a personal effect or not, then the estate trustee can decide that. So that's not a bad idea if there's going to be a group of assets or there's some question as to whether something fits into one category or another. The next question is, what happens if that asset doesn't exist at the date of death? That's the question of redemption. And what is the client's expectation if that asset doesn't exist at the date of death? So the first thing is rely on the common law rule of redemption, which means that if that asset doesn't exist on the date of death, then the beneficiary doesn't get anything. There's nothing, it's as if that gift was never made. So the other considerations are, maybe we want to do a tracing. So if that asset gets sold and it now becomes some other asset, do we want to consider that as the same asset? And so the idea of substitutional property, and I'll show you that with respect to land, but it's a problem with bank accounts, for example, where people want to leave this bank account, and then of course the bank account merges or they change banks or something like that. And so it's really a problem. And even the idea of tracing and how you're going to trace and to what extent and all of those things, always a problem. So, find a better reason than, I want this bank account to go to them, unless you've got really a way to think through that carefully. And the other is the idea that you give them cash in lieu of a specific asset if that asset is gone. Then you've got to consider things like what amount? Is it the fair market value at the date it was transferred? Is it somehow the fair market value at the date of death? Is it the net value? Is it, what are we going to do about that? And so just a bunch of questions to think about that where we could fall offside, or at least raise questions for the beneficiaries. And there's so many that, again, what is there a really good reason to give this asset to the client? I think that's to the beneficiary. I think that's going to be the theme of today's issues with drafting as well. Ownership is crucial in wills, obviously, and we try to make this clear to clients, but often they're not clear on it. And so here's a clause that I would routinely include because of the Willem case out west, where an asset was owned by a corporation and not by the testator themselves. And there was a gift of an asset that the corporation owned, and it lapsed because the testator didn't own that asset, the corporation did. Now there's cases that go the other way, but what I would like to include in my wills, and what eState does automatically if you use our software, it's going to include a clause that talks about if I make a gift of a specific asset that ends up being owned by a private corporation that I control, then I direct my trustees to take whatever steps they need through the corporation to get that asset to that person. Because you can see how that could be a major problem if either at the time the will was drafted, it turns out that they didn't really own it, or subsequent to the will, but before death, it was transferred into corporate ownership. So that's why I would recommend a clause such as this. It doesn't hurt to include it. If they don't own any corporations, doesn't matter. So personal effects often are expensive to transfer. So that's one of, they'd be personal property, and personal effects are a good example of that. So what we would like to do is sort of clean that up so nobody is arguing about it. So is it going to be borne by the estate, or is it going to be borne by the beneficiary? And it could be a large amount. If you've given a piano to somebody and they live across the, on the other side of the world in Australia, the cost of getting that to them is significant, and that's going to be paid out of the residue typically, unless there's some sort of provision in there. And even so, I would suggest you put in some sort of provision one way or the other, just so there's no disputes. And then there's the issue of personal property going to minors. And the most common example is, personal effects. You've got minors, maybe you don't want to set up fancy trusts to hold the photographs and, other personality. So a clause such as this deals specifically with respect to personal effects, I believe, but it just gives some flexibility to the trustee to deliver the asset to the child or to the guardian or parent, and that would be a receipt, or store them and deliver them to them when they're 18, those kinds of things. Just a little flexibility. You don't necessarily want to build a whole big trust about it, in my view, but you could. But this just gives some flexibility for some things that are of lesser financial value than others for minors. So those are the issues I wanted to talk about for personal property. And what I'll do is, just so you know, I'll answer the questions at the end. So the next big topic is real estate and devises. And we're not going to talk today about trusts for real estate. We're talking just about the simplest kinds of gifts. I want to give my investment property to John. That kind of thing. I want to give my house to Sue. So here are the issues that we came up with, even for those very simple kinds of absolute gifts. So let's just run through a couple of the drafting issues involved. So as we talked about for personal effects, the identification and definition is important, but here it's even more important in some ways. So the first thing is to make sure that, for me, I would always do a title search if I'm doing a specific devise of real property. that is not the time, in my view, to take the word of the client as to ownership, as to legal description or anything else, because it's so important that you get that right and that it is truly an asset that can be given away. So the first thing you'll want to do, I would argue, is confirm the legal description and use a PIN. Confirm if there's multiple properties. Maybe they think of it as one property, but it's actually a bunch of different properties. So that's another inquiry that you might want to make. Confirming ownership. This is the crucial issue. Yes, I own it by myself. Sure enough, it's jointly owned with someone else, or it's owned, as tenants in common, or it's owned by a corporation or something else. That is really important. And confirming that ownership, it's the best $20 your client will spend, and also that they will spend on you, because that's going to protect you. The other thing that a title search does is it identifies whether this might be an LTQ property, land titles qualified, and that whether the first dealings exception for transferring the property might exist, in which case you might want to think about doing a separate will for that real estate. So here's a sample drafting of the for real property, and this is the way we do it, but there's many ways to do it, and it just talks about the municipally owned, then legally known as, and then the legally identified as with a PIN. Then you'll see in the middle paragraph, and I've sort of separated these, so normally they'd all be in one paragraph, but this is covering substitutional property. So, if I'm dealing with the home that's our principal residence, that's the one I'm giving away. Well, I might want to use some language that talks about any other property that's purchased in substitution for that property and which is being used for a similar purpose at the time of my death. So that's that kind of language. And I often include this standard language that, if I only own a percentage of that property when I die, I'm still wanting to give that away. And I'm talking about that, my interest in this property when I use that definition of the home. It means, whatever interest I have in the home, in that real property. This is important. Associated assets, especially for condos. If your client says, well, I want to give my condo to so-and-so, often there are separate units that are parking and locker units, and that aren't part of the same PIN, maybe. So if that's the case, that's something you're going to want to include if that's what the client wants to include, and to consider whether you also want to include contents of that property is that included with the gift, or is that not included with the gift? Vehicles around, this is applicable often with respect to cottages that have boats. They might not be contents, but maybe those are to be included. So those are some issues to drill down on and draft around. So let's talk about associated debts. Unlike personal property, which often has no debt associated with it, real property often does. Mortgages, for example, on property, what happens with that? Well, Section 32 of the Succession Law Reform Act has a default in there, and it says basically the mortgage goes with the property. So if I gift a property that has a mortgage, the beneficiary gets the property and the mortgage. So that is the way it is by default. But you can decide how to do that, and the client can decide. Perhaps maybe the estate should discharge the mortgage first, and then transfer the property to the beneficiary. In that case, just so you know, if you're doing multiple wills, and let's say this property was in the secondary will, there may be a problem with discharging the mortgage out of the secondary will, or using the secondary will to discharge the mortgage, because you need probate to discharge a mortgage typically. And so you may want to include some special wording about in the primary will that allows you to discharge a mortgage that may be otherwise forgiven or paid off under the secondary will. So the next one is, I think, sometimes the biggest financial issue, and that is conditions. Conditions on taking the property subject to some financial obligation. And typically, the issue is the tax, the income tax, maybe even the probate tax on the property. So take an investment asset, for example, an investment property, and it's purchased for $100,000. And when the person dies, it's $1 million. Well, that's going to trigger a capital gain in the estate. The question is, who should bear that? So should the beneficiary get that property for $1 million and the residue pays the tax on the $900,000 gain in that property? Or should we make the gift conditional on that beneficiary paying the tax and not the estate? Because obviously that's going to have a huge burden on the residuary beneficiary if they have to pay the income tax on an asset that's not part of the residue, right? That's the double whammy. So the drafting that we use is basically saying, okay, if I do want to make this gift on condition that the beneficiary pays X, Y, and Z, then this is how we draft it. And we say, look, the gift, the transfer is made on the following conditions precedent. It's that the beneficiary shall pay or make arrangements that are satisfactory to my trustees acting reasonably for the payment of the following liabilities. And we build in, 90 days of receipt of notification of the amount of the following liability. So the estate trustee has to say, okay, this is the amount that we were responsible for, and this is the amount that you have to pay as the beneficiary. So here are the two examples for payment of tax. The first one is probate tax. So you've got to pay the estate administration tax or similar probate tax because the property might not be in Ontario, for which my estate is or becomes liable in respect of the home or whatever property you're giving. And two, we've got the drafting for the income tax. So this is the way we draft it. We say any income tax for which my estate is or becomes liable as a consequence of the deemed disposition of the home at my death. And basically I direct my trustees as soon as possible to determine that and notify the beneficiary of that in writing. Another example of expenses is who's going to pay the conveyancing costs, legal fees, those kinds of things. Land transfer tax is typically not, but applicable to the estate. But if that was, just in case, cover that off, or any other charges incurred by my estate in transferring the home. So that might be another condition precedent that he pay that as well. And then I say, okay, don't transfer the home until you've made those arrangements. And if he's unwilling to do that, then he's deemed to predecease me without a spouse or issue. And why do we do that? Well, we're just afraid of anti-lapse provisions. If J is a close relative, like a child, for example, there'd be anti-lapse. So I just want to make sure it's not anti-lapse. There's no anti-lapse issues. So they predeceased me, but he hasn't predeceased me for the purpose of any other gifts, just for this gift. And so that's how we do that. So that's a big issue that one should be concerned about anytime there's a specific gift of any asset, is who's going to bear any income tax and other tax or expenses in relation to that. For property, there's often ongoing expenses, property taxes, insurance, things like that. And so you might want to cover off who's responsible for paying that until it is transferred. We see that fight arise sometimes. And so better to just either have it by the estate or say, look, the beneficiary has to pay that as well. So you can draft around that. So deduct from beneficiary share. So it's the second last issue. So this is, and we're going to talk about options to purchase and how to draft those down the road. But today I just wanted to talk about this issue where the client says, well, oh, I want to give my investment property to John because, he'll use it and I think he'll be great managing it and everything else. And you say, okay, but, do you want him to get that plus his share of the residue? Well, is there a way to get around that? And yes, there is. And the way is that you give Jay the option to take this property because you want him to get it, but you don't want him to get it on top of everything else. You want him to get it as part of his share. You can say, you have the option to receive my interest in the home or whatever it is as part of her share. Now, I changed the name, by the way, from a woman to a man. So that's why it's saying her. Without negatively impacting the other beneficiaries of my estate financially. So I don't want there to be some argument that it's negatively impacting them emotionally or that they're not getting the right to buy it or anything else. I'm talking about financially, and that's why I put that in specifically. So that idea that he gets it, it should take into account not only what the value of that property is, but also the income tax, the probate tax, other testamentary expenses relating to that property, so that nobody's financially disadvantaged, right? That's the idea. And this is the hope that I expect that there's a simple manner for achieving this with the consent of Jay and all of the beneficiaries. And however, and so you could stop there if you have great faith that there's not going to be a problem. But what I often build in is then if that doesn't work, I'm going to build in a formal option to purchase. This is a much simpler way to do it. And if everybody can figure it out on their own, that's great. But if you can't, then we build in a more formal option to purchase. And then that is triggered if there's no agreement. So, but that's a way, that's one way anyway of, if the client says, when you ask them, why can't this just form part of the residue? Well, I'd like him to have it. He's always loved that item. He's always loved that real estate. He's always, whatever. Well, okay, we've got a way of doing that. So, it looks simple. Of course, there's all kinds of problems that can arise after the fact. And the last thing on real estate is environmental issues. So, if there's land and they have some environmental issues, there's some concerns that to what extent the executor is liable. And I'm no expert in environmental issues, but if there is that possibility, you may want to build in some sort of provision that allows the trustee to take whatever steps they need to manage and remedy any environmental issues and that kind of thing. And here's some standard language you could throw into your wills. So that's that. Let me just see what we've got as far as questions go. And I welcome, that's the end of the sort of formal aspects of the presentation, but I would love to hear if any of you have any questions that you'd like to address about the drafting on quote, simple bequests and devises. So. Anything there? I'm just gonna, for those who, while we're waiting for some questions, the way obviously you would do a gift in eState is you'd simply drag it, drop it, pick the beneficiary that you want, and then add whatever conditions you want. Oh, I want him to pay the taxes. I want him to pay the probate. I want him to deduct that gift from his share. You just build that and then you click draft and it'll draft all of those provisions automatically. Let me see, we've got a couple of questions in here. So the first is, do expensive vehicles fall into the residue of the estate or is there a definition? Well, vehicles typically are part of the personal effects. In the definition of personal effects that I typically use, I talk about vehicles. If you wanted to exclude that, you should deal with that differently. But the standard language does have vehicles in there. On the second last item, do you combine that with another clause? I don't understand the context of that clause. So let me just I think that's this clause. So yes, I put this clause in, and then I have another clause that says, okay, and if you can't deal with it, I want to put in, here's my option to purchase. I give Jay the option to purchase, a formal option to purchase it from the estate with all the different rules about that. And then you can sort of fill those in, or those get drafted. So let me go to the Succession Law Reform Act to answer the next question. Section 31 of the Succession Law Reform Act. And we have a question about anti-lapse. So it's Section 31. Give me a second here. And I will call up. Anti-lapse is also known as substitutional gifts right here. So unless there's a contrary intention in the will that's expressed in the will, if a gift is made to a child, a grandchild, or sibling who predeceases, and it basically goes to their next of kin. It goes to their spouse and their issue of the predeceased beneficiary. It doesn't lapse. And so the reason I want that, if that person doesn't come up with the income tax for value and doesn't want to pay that, then I want them to predecease for all. I don't want to go into their issue or their spouse. So that's why I say predecease and without spouse or issue. So that's the idea of anti-lapse. And maybe down the road, we'll talk about lapse and how to deal with lapse and gift overs. I think that will be a good topic. And so maybe we'll do that even in the next couple of weeks, and we can talk about anti-lapse in a little more detail. So that was that. I just wanted to show you, I think I can give you the context of the, oops, give me a second here. I don't want to simplify provisions. So I'm just going to show you that clause about hodgepodge and option to purchase, just to show you how that sort of works together. So are there any other questions? I think James makes the point that, yes, the cost of storage can be significant, for sure, can. It's something to consider, especially depending on what you're storing. It can be a big issue. So for sure. Anything else? So a couple of other points. I realize that you probably can't see anything because I'm sharing only my, let's do a new share here and do this whole screen. And the clause will draft the, just show you that option to purchase. Remember, I just clicked off that I wanted someone, I don't remember who it was, to get the home. Oh yeah, here it is. So this is the clause that talked about, I want you to find an easy way to do it. But if you can't, now I grant an option to purchase, and then go through all the different things that we do in an option to purchase. So that's how that. So what about royalties? Yeah, they're an issue. So obviously defining what they are and being able to transfer them is an issue. I think, you can certainly do it. You just have to make sure it's clear, and you might want to get some advice from an IP lawyer about how to draft that to ensure that all the rights that you want are given, and all the rights you don't want aren't given. So I would seek out some professional advice on that issue, especially if they're valuable. How would you ensure that an expensive vehicle falls into the residue of the estate? Well, I would just say, with respect to my 1974 Dodge Caravan, that shall fall into and form part of the estate and shall not be part of my personal effects. So you could just draft it like that. That's how I would do it. So that's how you do it. Just a couple of things. As I said, the formal webinar is over, but you can stay. We now, for those who didn't know, we now have reporting letters. So you can send your clients automatically generated reporting letters, escrow agreements, and things like that. Just pick, you can customize them, and then just it will automatically draft it. It's quite helpful for, if you don't use reporting letters, I would strongly recommend you considering using them, because they're very helpful, and to protect you. That's really what they're most useful for. About who's keeping the originals and where are the other ones and when to review it and how to change it and don't write on it, and restricting your retainer and things like that. It automatically determines, is anybody a U.S. citizen, and if so, put that warning in there. Did you do an RSP designation? Things that you do normally, it's going to pull the data from your specific client and put in the right clauses in the reporting letter. So anyway, so play around with that for those eState users on the call. There's that, and you can customize it, just so you know, under documents, reporting letter, and you can set, how do you normally send it? What's your reline typically? Who's your default? Do you normally, how do you want to set your defaults and fonts and all of that? So, so that's that.